Okay, great. So today we're going to look at correction. Correction is very important when it comes to trading the strategy because with correction, sorry, spelled it wrong. Remember what we spoke about last week, right? Last week we said that, or previously, what we've spoken about is how the market moves. The market is always going to move in this direction, right?
Yeah.
The market never goes in one direction. The market just doesn't go that way. Or if it wants to go down, just determines to go down that way. It doesn't work like that. The market is always creating either higher highs and higher lows or lower lows and lower highs. So when it's a bullish structure, like we mentioned at the time, it forms higher highs and higher lows. If it's a bearish structure, it forms lower lows and lower highs. Let's make this one red so you can see the difference. So like you said, that's a low. That is a high. This becomes a higher low because it's higher than the previous low. And this becomes a higher high because it's higher than the previous high. Let's put this one here. And it's the same for these ones as well. It's the same for these ones as well. Yeah, so that's an indication for a bullish market, right? Let's look at what the bearish market looks like. So this is going to be a high, and this is going to be a low. So with a bearish market, it means that lows are being broken, right? So we're going to have a high which is going to be lower than the previous high, which is going to be a lower high, and then a low that is lower than the previous low, which is going to be a lower low. So lower high is being formed. And lower lows being formed. And from what we did last week, we said that, so the market literally has this, right? The market literally is made up of a bullish market, a bullish trend, bearish trend, and sometimes the market doesn't know what to do, so it consolidates, right? I mean, it means that it's not necessarily breaking lows or breaking highs. It consolidates, and anytime a market is consolidating, like I mentioned to you guys, you don't want to trade it, you just want to watch it because it doesn't give you a clear indication of what it wants to go. So what I do with like things like that is that I don't trade that. I just watch it play out until we're higher. Until a high or a low is broken, then I'm just gonna leave it. Like I said last week, the breaking of a swing high or swing low is an indication of where the market wants to go. So in the case of a bullish market, right, this is a high. Anytime this high is broken, it indicates to us an indication of what wants to happen in the market. Do you understand? Anytime a low is being broken, this low is being broken, this low has been broken. Anytime a low is being broken, from that point, it's an indication of what the market wants to do. So it doesn't mean that the market wants to go down, but it should let us know that, okay, the market is likely to go down. So today, what we're going to speak about correction. Correction is when we are going to put the indication and correction together because it's a three-step strategy, right? It's a three-step strategy, like I mentioned at the time. So the strategy is number one, indication. Number two, correction. And number three will be continuation. That's what the strategy is all about. We've done indication. Today we're going to look at correction. It's very important for you to pay attention because this will help form the basics of how you understand the strategy, right? So let's put this here. Let's take our path tools and then let's do this example, right? The market, all the market, anytime, like I said, it wants to go up, it goes that way, comes this way. So it goes this way, creates a lower low, right? So it creates a higher low because that high, that low was higher than this low. So anytime the market breaks something, that high that it broke indicates to us where the market wants to go. But I remember what I said, the market moves in waves, right? So it's not going to go all the way that way and just keep going. No, it has to correct. So the correction part is this, it's correcting. Now, if the correction breaks this low, that gives us a new indication of what the market wants to do because it has broken a low, right? But if in the case of a bullish structure, right, the indication, because it's broken this high, it indicates to us that the market wants to go up, right? And then the correction and the continuation. So the continuation creates another indication because it's broken this high, and then the correction and the continuation, and then this high is being broken. So the indication because it's broken this high, correction and continuation. So that's how the market moves. If it wants to go down, if it wants to go up, that's exactly what's going to happen. If it wants to go down, that's exactly what's going to happen. It's going to be the high and the lows in the market, and then it corrects itself. And then obviously what happens is that this low is being broken. So anytime the low is being broken, like I said, the swing high, swing low being broken, it indicates to us where the market wants to go. So if it breaks this one right now, we know that the market wants to go down because the last low has been broken. So that's the indication. And then what happens with the market if it wants to be bearish? It continues, then it corrects itself, and then it continues breaking another low. Then that indicates, right? Indication because that low has been broken. Then it corrects itself, then it continue. So that's the strategy. Indication, correction, continuation. Indication, indication, correction, continuation. But the continuation is also an indication because it breaks the low. So indication, correction, continuation. That is the strategy. But today we're going to focus on just continuation. So let's draw these bars, right? Let's say
One question.
go on.
So would the correction be like, if you're looking at that chart you've done on the left, would that be like the low highs? If to the left there, yeah, because you have the high, you have the low,
That's it.
and then you have the correction, which is the low high, then you have the continuation and the indication because it's broken the previous low.
Yes, so correction. Yes, so correction in the bearish market is always the formation of lower lows and lower highs. That is the correction. Anytime you're seeing lower lows and lower highs being formed, you know that is a correction being made because a lower low has been formed, a new lower high. The high that is made from the low is what tells you that the correction has almost begun to be completed for the continuation to begin, right? So remember what we said at the time, right? In the market is made up of buyers and sellers, right? So let's make this one our sellers. Let's make this our sellers, and then we're going to make this our buyers, and I'm going to explain why that is. The market is made up of sellers and buyers. They will tell you support and resistance, right? The reason why it's sellers is because if the sellers are selling at this point, right, and maybe the amount they are charging to be able to pass through that border is maybe £1,000. Yeah, let's say $1,000 to be honest. $1,000, right? That's the amount of money that anybody needs in order to go above that. And then the buyers here, they have only the buyers here, they have only $2,200, right? They only have $200. What that means is that they don't have enough money to be able to break that because they are charging £1,000 for anybody to go. It's like going to a concert, right? And then when you get to the gate, they tell you that you have to have £1,000 in order to be $1,000 in order to be able to get into the concert. But then you only have $2,200. It means that you will not be able to get through there because you don't have enough money. So in as much as you're a buyer, you only have $200. You have $1,000, right? So you'll not be able to go through them, right? So sellers are telling you, listen, if you want to come above us, you have to pay $1,000. And then the buyer saying that, oh, I only have $200. So what happens? If you only have $200, you have to go back, look for more money before you come, and then try and, go past us, right? So it means that the sellers would have to, the buyers would have to go back and then gather more money. They can decide to go and get maybe $1,000 more, right? They can decide to go get $1,000 more. So right now they have like what, $1,200, and then once they have $1,200, they have enough power to be able to go above them. So now they are at this point. Now they are inside the concept, and they have $1,200. They have to, because they had $1,200 to go past the sellers. Do you understand? So that's the whole. That's the way the market goes, right? It means that anytime you get into the market, buyers are pushing the market up in a bullish situation, and then when they get to this point, they didn't have enough money, right? So they came back to grab some more money. They came back to grab some more money in between this. And then when they got some more money, they went back to test it if their money was a lot to break that low or that high. It was a lot to break that high. So guess what? They went above it. And then they come back, maybe they get to this point, and when they get to this point, it's $2,000 that is needed. So they only have $1,200. It means they have to go back to look for what, $800 more, or maybe more than that. Let's assume that they go back to get $1,000 more. And because they have $1,000 more, now they have $2,200. So they're able to go above it. That's the whole thing of how the market works. So today we're going to speak about the liquidity and the continuation. Continuation is liquidity. So that is the fact that the market was going a direction, right? We know that wants to go up. Buyers are pushing the market up. It gets to this point, and when it got to this point, it didn't have enough money to be able to break that zone, right? That support zone, that resistance zone, which is where the sellers are. A lot of sellers are here. The reason why a lot of sellers are here is because anytime the market went to that point, it came back here. And then the buyers pushed it up, and they came back here. Then the market pushed it up, the sellers push it down, because they don't have enough money to be able to break that zone. But guess what? When they went ahead to get more money, they were able to break that zone, because now they have more money to break that zone. So what is correction? Correction is when the buyers, right? So let's assume that this is here now. Correction is when the buyers go gather more money. And then when they gather more money now, they're able to go above it. That is what correction is all about. So correction is higher highs being broken to indicate the market wants to go up, right? And then it comes to correct itself because it got to the point where they didn't have enough money. So they come back to gather more money from people who have their stop losses set up over here, grabs more money, and then continue. So the correction part is the grabbing of more money. The correction part is the formation of higher. So in the case of a bullish structure, right? Let's make this one green. In the case of a bullish structure, if you look at this point, in the case of a bullish structure, the correction is always the higher highs and the higher lows. That is what the correction is all about. Creation or formation of higher highs and higher lows. That is the correction. So correction is indication being formed, correction, and the indication being formed, the high being broken, and then correcting itself, going to grab more money in order to be able to be strong, to go above where the new sellers are. So at these points are sellers. Sellers are always lying at this point. That's where they call the resistance level. These sellers are always here at this point. These sellers are always here at this point. So when it gets there, it bounces back and corrects itself to gather more money. And then if he has more money, then he has the power to be able to break the selling zone or the support zone. It breaks it, or the resistance zone, sorry. It breaks it and then moves to the next stage. And then if he has more money, if he doesn't have more money, it comes to grab more money from here. That's the liquidity grab. It grabs more money from the people who have their stop losses set below here. Because the thing is that when people get into the market, right, and it's moving like this, they are trying to see, okay, the market was going all the way up, right? And then they see that, okay, the market is coming down now. So when they see the market is coming down, they think the market is going to go all the way down. So what they do is that they set their stop losses in these areas, right? They set their stop losses in these areas. So what the market does is that it comes back because it wants to go into, it wants to gather more money to be able to break this zone. it comes back to grab more money, and then it's able to have that power to be able to break this high, which eventually goes to break this seller zone and then begins to move all the way up. So let's see this one as well. There are different types of correction that you need to pay attention to, because sometimes if you don't want to be stopped out, if you don't want to be stopped out, it means that you have to pay attention to how the corrections are being made. So I'm going to show you how. So in between the buyers and sellers, right? Let's take our path 2. This is an example of how correction takes place, right? So remember what I said. Anytime the market is confused and doesn't know what to do, you just have to leave it, because it's not giving you a clear indication of where it wants to go, right? It's not giving you a clear indication of where it wants to go. So this becomes an indication, and the correction can be like this, and then it continues, right? So that's one example of a correction. This is one example of a correction. Now let's do another example of a correction. There are 3 types of corrections that you have to pay attention to, and that's the first type of correction that you need to pay attention to. So that is the first example of correction that you need to pay attention to. Now, this is also an example of a correction. Assuming the market is just moving, the market is moving in between these lines here, these 2 highs and lows. So this is a high, this is a low, right? The market is moving in between them, right? So it goes this way, comes this way, goes this way, comes this way, goes this way, goes up. Buyers, sellers push it down, buyers push it up. Sellers push it down, buyers push it up, so it breaks the zone, right? The correction can come all the way to this point. As long as it doesn't break that low, it's still correction, right? Because what's going to happen is that if it's actually a correction, then it can continue from here, then begins to make like higher highs, and then begins to go up. So that is also another example of a correction, because at this point, this high was broken. This high was made by this low, and this high created this low, right? And then what happened was that this low created that high, but that high was higher than that. Because it broke that zone, it gave us an indication of where the market wants to go. And the correction is the fact that this low that created that high has not been broken. It means that anything that forms in between the two is a correction, right? So that's another form of correction. Let's move to the next form of correction, the third form of correction. Yeah, it's very important to pay attention to this, because if you really get to understand this part, anytime you're in the market, it's not going to be difficult for you to be stopped out, because you understand where the correction is. And this is also another form of correction, right? Goes this way, comes this way, goes this way, comes this way, goes this way, comes this way, goes this way, comes this way. When it has the power to break that structure, it can come all the way to this point, and it begins to go up for a continuation. So that is also another example of correction, right? We've got 3 forms of correction right now. We've got this correction, which sometimes can be up there and it begins to go. So this is the first form of correction. There's another type of correction. This is also another form of correction where it comes to the level of where the previous low was broken, right? So it gets to that level where the previous low was broken, and it begins to make its way up. So that's correction. This is a bullish indication of correction, right? Let's look at the bearish indication of correction. Let's see what it looks like for it to be bearish, because we've looked at the bullish part. Let's look at what the bearish one is going to look like. So let's see. Okay, so that's a bullish example of what the correction will look like. Let's look at an example of what correction will look like on in a bearish situation, right? So these highs, the buyers and the sellers are, they are just doing their thing over here. In a bearish situation, it breaks this low, right? And it comes all the way to this point. And that's an example of continuation. So this is the correction after the indication, because it broke this low, this lower low, broke this lower low here to indicate where the market wants to go, and then it corrected itself by going up a little bit. That's an example in a bearish situation. Let's do another example of how correction will look like again. So it breaks it, then it comes all the way to that point. That's another example of a bearish correction being formed. As long as that high is not being broken, it doesn't matter how long it goes. It doesn't matter how long it goes. As long as this high is not broken, everything that's happening here is a correction to help with the continuation of the market. Let's have another example. Another example of a bearish continuation will look like this as well. It breaks that to indicate where the market wants to go, and it comes back to retest the same level where it broke as well, and that's an example of a bearish. So when it comes to bearish corrections, these are that's an example of a bearish correction, and then these are examples of bullish corrections. Let's try so this correction, this is examples of how it looks like when it's bullish, and these are examples of what it will look like when it's bearish. So you don't get confused at all. It is very simple, it's very easy. Remember what I said, the market moves in waves, it doesn't go in one direction. So when it comes into the bullish correction, anytime the last low or the last high in the bullish situation or case, the high has been broken, right? So it indicates to us that the market wants to go up. That's an indication. And this is an example of a correction. It corrects itself, right? What the correction means is that this low that was formed from this high was not broken, right? So that's the first example of what the bullish correction will look like. This is another example. As long as that low that created that high is not broken, that which is being formed at the moment is still correction. An example of that as well is this one as well. It comes back to retest the same level that low was broken, and then from there it continues from there. So this is the bearish situation as well. You have lows being broken, and then obviously once it broke, it gives us an indication of where it wants to go, and then obviously it corrects itself. And in this situation or this example, the low was broken, and then once the low was broken, it went all the way to that high that was formed, but it wasn't able to break it. So that's a correction, and it continues from there. And this is another example where the low was broken to indicate where the market wants to go, but then it goes back to retest where that low was broken. So these are examples of what the corrections, for example, in the bullish and the bearish. All right, so let's go actually on a real market, and let's see. Sorry, there's some music playing in my background. So if you hear music in the recording, I'm so sorry. They're having an event in my building, outside my building. So it's like there's a lot of noise. So sorry about that. All right, cool. So let's look at examples of what corrections will look like in a real chat, right? So let's try it. If you come into the market right now, I'm looking for from this levels. I'm looking at where my highs and my lows are. Right. Let's take this example for example. So I'm seeing a low here. I'm seeing a low here. I'm seeing a higher low here. I'm seeing a high here. And that high, this high created this low, right? This low came from this high, but that high has been broken, right? So the minute that high was broken, it gave us an indication of where the market wants to go. So this was a high, this was a high. Let me actually name them. This is a high. This is also a high. But the high was broken. Remember what I said? Anytime a high is being broken or a low is being broken, it indicates to us where the market wants to go, right? And then this is what broke that high. This is what broke that high. You know that little thing up here?
Yeah.
In as much as it's not as big as this one, that small breaking, it indicates to us that the market wants to go up because it's broken the previous high. So this has become our new high then. So this has become a higher high. This has become a higher high. Why is it a higher high? Because it's higher than this high in this particular place, right? And then because that has indicated to us, it's telling us, okay, the market wants to go up. And then what happened? A correction happened. The correction happened from this point to this point. That is a correction. I'll tell you why. Let's draw with our path too. So this was a low, created a high, created a low, created a lower high, created a higher low, created a lower high, created a higher low, created a lower high, which is equal with this high over here. So it's an equal high over there. And guess what happened? It created this low, right? And then it went all the way to create a new high. Indication, it broke this high. It indicated to us where the market wants to go. And the correction part is what we're talking about. Remember what we said? The indication is because it has broken this high. And the correction, as long as this thing that is being formed doesn't break this low, it means that this is a continuation. But the continuation is not breaking any highs or lows. So if this continuation broke this low, then we know that the market also wants to indicate to us that it wants to go up. But in this case, after this high was being broken, it only came and then it ended over here. So that is the correction that happens in the market. The market corrected itself. Remember what I said, the market always moves in waves, right? So the high was broken, it gave us a new high, and it indicated to us where the market wants to go. And this is on a 1 hour time frame. It indicated to us where the market wants to go, and then it corrected itself. And then the next part of the strategy is the continuation, right? So the continuation is where it goes back to break that high that was formed, which is what we saw here. So it's very simple. It's just you understanding that anytime highs and lows are being formed, you're checking, okay, is a high being broken? Is a low being broken? Okay, if a high is being broken, did the continuation occur, or did the high that was broken went back to break the low that was formed from that high? You have to ensure that you visually see that, and then once you get to see that, you'll be able to understand it. Don't forget what we mentioned the other time. Anytime higher highs and higher lows are being formed, you are in a bullish market, right? So in this situation, right, we know that there was a high here, that obviously this low was formed, and this is a lower high that was formed. But then from this point to this point, if you take your path to, you'll be able to see some highs and lows being formed here as well. Do you understand? You'll be able to see some highs and lows being formed here at some point. But it's not really structured like that. So with you, you're not trying to chase everything. You're trying to find the key points, the swing highs and swing lows. This is a swing high. This is a swing low. The minute that swing high is broken, right? The minute that swing high is broken is indicating to you of something that the market wants to do. The market is indicating that it wants to go up, and then it corrects itself. And then once it corrects itself, then you know that, okay, correction. I'll show you guys when we get to the entries, which is the continuation part. We'll do that sometime next week. The entries, which is the continuation part. Once we get to that point, you get to know that, okay, at what point does this correction, at what point does it actually happen? because we don't trade indications, we don't trade corrections, we only trade continuations. So how would you know that the correction has ended? Because without the correction ending, you wouldn't know if the market wants to continue or it wants to go back and break this low. You wouldn't know that, right? So the correction is what will let us know whether the market actually has completed what it's doing and wants to go into the continuation phase, which is what we are going to tackle next week for the entries and continuation. So for today, just know that anytime a high and low is being broken, that is an indication of where the market wants to go. And the market corrects itself anytime an indication happens. It corrects itself, and then once the correction is completed, and continuation is being formed. So with me, I keep telling you guys all the time that the best part, or the best way of you trading, right? The best way of you trading will be the higher time frames, right? Because the higher time frames gives you everything that you need to know. For me, I do my we'll go into more details next week for the entries and continuation. But what you're trying to do is that your you're trying to use the 4 hour time frame to find your direction, right? You use a 4 hour time frame to find your direction. You can do that with a 1 hour, but usually what I do is I go on the 4 hour time frame to determine what direction I want to go into, and then when I do that, then obviously I go into 1 hour to get a little bit of structure. When the 4 hour hasn't given me the clear structure, then I take my indication, the correction and continuation from the 15 minutes time frame. So anytime indication is being done, you're looking at that on the 4 hour, right? And then you go into the lower time frame, 15 minutes. So the correction and continuation always has to take place in the 15 minutes or the 5 minutes time frame. So when it comes to correction with me, I'm looking to take corrections from sorry. Oops. What did I do? I hope I didn't mess anything up. Oh, okay. Yeah, there we go. Yeah, so when it comes to correction with me, I'm always looking to do the correction on the 5 minutes or 15 minutes time frame. That's where I look for my corrections. It's always done on the 5 and 15 minutes time frames, which we are going to, get more into details once we begin to put the whole strategy together. So yeah, today it's very simple. It's very easy. It's corrections. Corrections are very easy to identify. For the bullish, this is how the correction looks like in the bullish. The market breaks a swing high or swing low. For the bullish, it breaks a swing high, and then when it breaks a swing high, the correction happens. In this case, it gets to this point. That's a correction. Sometimes it comes all the way to test that low there, and it doesn't break it. As long as it doesn't break it, it's still correction. Sometimes it comes back to test the high that was broken. So that's the bullish corrections, and that's how the bearish correction also looks like as well. It breaks the lower low, and then when it breaks the lower low, it corrects itself, but it doesn't go to break that high that was formed there. In this case, it goes all the way to that point, but it doesn't break that low, so it's still correction. And then in this case as well, it gets to test the low that was broken, and then obviously from there it can continue, which is what we're going to look at next week. So for today, it's very simple. That's what we need to do today, and I gave you an example here. In a bullish example, actually, let's try and do an example for a bearish example as well. Let's do a bearish example for that. Yeah, this is good for a bearish example. Let's do this. So we see that in this, when we come into this point, we are seeing lows, right? This was the last low that we saw at this level, right? That's the low that we saw at this level. And then this low, we saw that it broke this low, right? This low that was formed here, this low that we saw, which was a lower low, got broken, right? And when it got broken, a new lower low was formed, right? A new lower low was formed here. And then this then, from this lower low all the way to this point, becomes the correction. So from here to this point becomes a correction. But in this particular case, it's very, very interesting because this is something that we're going to speak into details. Because not only did this happen, the correction went all the way. Because remember that I said to you guys, right, that this low, this is a high as well, right? And it created this low. So this low has been broken and it's correcting itself. But the correction didn't just end here. The correction went all the way to this point, but it didn't break this high. right? So the correction got to this level, and then once it got to this level, then the market started to continue all the way on the downward spiral. Because what I said was that anytime the market breaks a low, a swing low, it indicates to us in a bearish case that the market wants to go low, and it corrects itself and it continued, right? So if you're trying to make money from this point, you're going to enter the market at some point here. You put your stop loss there, and then you take your first step. Your first take profit will be at the previous low, and then obviously in this particular case, it went all the way to that level. So that's a 1 to 5. You understand? So for now, today, that's a bullish example that I showed. This is a bearish example. Low being broken, and then it corrects itself before it continues. And then in the bullish case as well, like we said, this was a high. The high was broken in this. It doesn't matter how small the breaking is, because 21, it doesn't matter if this one is 21, this is 22. Even though it's just 22 is still higher than 21, right? So at this level, the price was 24,918.06, right? And at this level, it's 24,962.21. It's still higher than that. So that's still an indication of where the market wants to go. It corrected itself and it continued to create some more highs, which indicated a bullish, market or a bullish structure. So yeah, that's it for today. I hope you guys understand it. And let me just go back to this and then make sure I get you guys to understand the picture that we drew today when it came into the correction. Next week, we'll be able to go through the continuation, and then maybe we can put the whole strategy together. And then we put the whole strategy together, and then we'll be able to, begin to do some trades. I think in the Discord, I put the trades that I caught in the Discord last week on gold. I got some gold buys and gold sells. I think it's here. Let me see. Yeah, so I made some money doing, I caught some sales here. Yeah, I caught that, and then there was a buy that I caught as well. I think I caught some buys here as well. I think I got from it broke that swing high. A high here, it broke that high. It came to retest it, so I was able to make some profit doing this as well last week. So yeah, that's it for today. I'm gonna see you in the next video. I'm gonna I hope you, like I said to you guys, it's a mindset change, right? You just have to change your mindset. It's not easy. It's not difficult at all. Sorry, it's not difficult to understand. You just have to put in that work, get to understand. If you don't understand, watch the video over and over. It doesn't matter if you watch the video 1,000 times, just to understand what indication is, just to understand what the correction is. Do you understand? It doesn't matter how many times you do it, because once you get it, that's it for you. Once you get it, that's it for you. You'll be able to make so much money doing that. But guess what? It's all up to you. It's already in you. And I keep saying and preaching this to you all the time. It's already in you to be successful. It's not outside of you. So you're not going to look outside of you to look for that success. You're going to look inside and within you to be able to find that thing that God has put in you, and then make the money that you need to make from it. And the purpose of us making money is not so that we tell other people that we have more money than them. The purpose of us having money is so that we let people, we're able to help people. Do you understand? We're able to support the things that we're able to support, but ultimately to be able to help people and put them in positions where they can also prosper. So that's it for today. I'll see you guys next week.